Today we're in a new part of Miami Beach we haven't walked in yet. I'm at the corner of 47th Street and Pine Tree Drive, and I'm going to take you guys through the neighborhood over this way, and we'll probably walk by the newest Ritz-Carlton building that they built a few blocks from here and just check out this area. Now, one thing we need to talk about, guys, is the real estate reset. What is that? Well, a lot of you might first think of the Great Reset. It's not really quite what we're talking about here, even though it is a little bit related. But the real estate reset is what the Fed is trying to do. In fact, Jerome Powell said it himself at the previous Fed meeting that the goal right now is to sort of reset the housing market to cool down prices back to an affordable level. So what exactly does that mean? Nobody really knows, and we can't really predict the future. We don't know what's going to happen with the market and just how far prices are going to go down. But rest assured, one of the Fed's biggest goals right now, besides slowing down inflation in the economy, is also to slow down the housing market. So what he said at the last meeting, and this is a quote, is, "For the longer term, what we need is supply and demand to get better aligned so that housing prices go up to a reasonable level and at a reasonable pace, and that people can afford houses again." So that's one of the goals of the Fed right now, is to make housing affordable again. So you can just use your imagination here of where mortgage interest rates might go to make housing affordable and what prices might have to be at these high interest rates to be affordable. You can take some wild guesses on that, but we're going to talk a little bit more about that later in this video too. Now, another part of this that people have to understand is this. In order to slow inflation, consumers have to slow consumption, all right? Buying new houses or existing houses increases consumption, all right? More tangible hard goods, that creates demand, that drives inflation and pricing, all right? Every house sale, every time there's a closing and somebody buys any type of property, there's a lot of things that happen, guys. Realtors get paid. People like myself make a decent sum of money, okay? Movers get paid, and people have to buy supplies and boxes, things like that. They have to pay the movers. They got to rent the U-Haul truck. They got to buy gas to put in the U-Haul truck. People buy furniture and they sell furniture to other people. They have to buy new appliances sometimes. So when you have a transaction just from one home being sold, this is a way to sort of stimulate the economy, and it increases inflation because it just keeps demand going. It keeps the velocity of money flowing. So every time we have a closed sale, we have more inflation problems, and it's going to lead to essentially higher home prices in effect. So here's one thing that everyone needs to think about right now. If you want to see lower home prices, if people are complaining that everything is too expensive and I can't afford to buy anymore, if you want to see that happen, then what needs to happen, guys? People need to stop buying houses. You essentially need to boycott the housing market. You need to have people sitting on the sidelines indefinitely, but it's not going to work unless it's a collective effort, and that's where the problem comes in, because some people are just more well off than others and will buy no matter what. Like we talked about many times before, life will keep moving, and because of that, that actually keeps things propped up as well. Besides the Fed playing all these financial games and holding on to the mortgage-backed securities and all of this, that has a big impact on things as well, along with the interest rates. But basically, an easy way to understand this is the more home sales that you see, then that keeps things more expensive, because the longer homes sit on the market and the more inventory builds, if everybody's not buying, then things will get cheaper in a hurry. So think about that if you're considering buying right now and you're not happy with the prices at these rates. And this kind of ties directly into my next story, guys. And one of my viewers, Lynn, she sent me this morning while I was planning this video, coincidentally, and it just ties in perfectly with this. And I have to rip on this. So Josh Flagg, one of the $1 million listing real estate agents from Southern California, he's saying that you should purchase a home right now because interest rates are going to go even higher. So I'm going to tell you why this is like the dumbest thing I've ever heard in a minute. But let's first go over what exactly he said here and why this is stupid, okay? So the first thing he says is one of the biggest mistakes that home buyers make is getting too hung up on the price tag and nickel and diming. Now that I actually agree with, but that has nothing to do with purchasing right now or whatever. That's more of a person's mentality and not being able to handle the transaction right. I've had buyers that, you know, they won't go an extra $5,000 to get the deal, which to me is stupid, because if you really love the house and you're not willing to spend the extra $5,000, then you're probably not really that serious. So in that respect, I agree, okay? Because what he says is if you do that every single time, you're going to lose out on every deal and you're never going to get the house that you want, because no house is perfect unless you have an infinite budget and you can afford to buy whatever you want. I agree with that, okay? So being nitpicky and, you know, not willing to budge a little bit on the price or sacrifice maybe one feature and everything else is perfect, yeah, that's where people get hung up too much. This is one of the newest buildings here in Miami Beach. This is the Ritz-Carlton Residences. I don't know if they actually do hotel stays here also, just like a lot of the Ritz-Carltons do. This is mainly just people living here now. And of course, it's super expensive. I'll put up a listing on the screen of an example of what something costs here. The units here are pretty expensive. They range from about $4 million to $8 million. Now, what I think is happening with Josh Flagg is he's probably getting desperate. Well, why are you saying that, Michael? Well, obviously the housing market is in big trouble right now. Sales are dropping through the floor pretty much everywhere, and specifically luxury sales are down, guys, and that's what this guy focuses on. All of his clients are, you know, bigwig luxury buyers essentially. So according to Redfin, luxury home sales are down 28% year over year, guys. So that is extremely low. And luxury sales are always lower than regular home sales because there's just less buyers for them. You know, less people can afford homes like that. So naturally you're gonna see less buyers and less sales for luxury homes. But now it's even worse. It's so bad that if you need to get a mortgage right now on a luxury home, somebody that would have had a $1.5 million budget last year, well, now because of interest rate hikes, your budget's $800,000. So you can just imagine what kind of an impact this has on luxury sales. It pretty much crushes them because, you know, going from a $1.5 million home to an $800,000 home is like a night and day difference when you're talking about features of the home and all of this and just the quality of life you're going to get from that home. Check this out. Across the street, they got all these townhouses they're building over here. I think that's what they are. I'm not really sure if it's part of the Ritz-Carlton or not. I don't follow that too much. But they're all under construction, and you can bet they're all going to cost a pretty penny, that's for sure. Now here's why whatever Josh Flagg is saying is completely idiotic, guys, and it's basically the exact opposite of what I've been telling you guys on this channel. So you can pick your sides right now and decide who you want to listen to. I don't care if you decide to listen to him, but let's just break down his logic here for a minute. Here's what he says. Wouldn't you rather lock in a 30-year rate and have easy payments every month rather than waiting until next year and having a higher payment every month, even though you've got a little bit of a better deal on the property? That's moronic, guys. Why is it moronic? Couple reasons. First of all, yes, interest rates will probably be higher next year. Most likely they will be. But prices will also very likely be lower. And one thing you can always change eventually on your home purchase is your interest rate, okay? One day you'll be able to refinance. Who cares if it's 5 years down the road, you got to pay a 7% interest rate next year or even 8%, whatever. You pay 8% next year, but you saved 50 grand or 100,000 on the home purchase, okay? And then 5 years later, you're able to refinance and get a better deal, even if rates come down to 5.5%, or that's probably where they're going to be sitting once things normalize, you know, in the mid fives. That's my guess, eventually, maybe into 2024. So to me, it's exactly the opposite of what you should do, guys. To me, it's like, wouldn't you rather have a lower home purchase price that's going to benefit you in two ways? You're going to be having an easier time to qualify, and your property taxes will be lower. So those are two benefits to you right there, and you'll be able to refinance down the road. Versus if you listen to Josh, you're going to be stuck with the high home price that you paid forever. You can never change how much you paid for the house, guys. And then when rates go down, sure, you'll still be able to refinance, but that's assuming you have equity. If you don't, which likely you don't because you're buying at the peak of the market right now, you won't be able to have that refinance opportunity. So this guy is giving terrible real estate advice, and my guess is he's desperate because luxury sales are down. So let me know what you guys think about that. To me, it's just simple math, guys. There really shouldn't be an opinion on this. The math is that the lower home price you pay, even if it's at a higher interest rate, that's always going to be the better deal because you're going to have more equity when it's time to refinance, and you won't have any if you buy now and home prices drop $100,000. So there's that. And you're just going to be in a better financial position, okay? Do the numbers. I'll even put some scenarios up on the screen here so you guys can get an idea of how this works better in your favor to wait and have a lower home purchase price than listening to Josh Flagg. But obviously he's not completely stupid. He does have some good advice. And another thing that I agree with him on that he said in this article is that, you know, you want to buy as much real estate as you can and you want to hold on to it for as long as you can because in the long run, you don't lose money on real estate. And I agree with that, guys. But he says nobody goes broke, nobody gets hurt financially owning real estate, which is not true. That might be true if you live in the $1 million listing world and you live in Los Angeles and you're a multi-millionaire. Yeah, maybe you're not going to lose. But for the average person out there, which is pretty much everyone, you can easily lose your shirt on buying a house right now. You can pay $400,000 for a house that used to cost $275,000 right now, and if the value goes back down to $325,000 or $300,000 in the next couple of years, not only are you underwater on your mortgage, but you will not be able to refinance that house. And if you get into some kind of financial trouble, forget about it. You're going to lose the house, you're going to go into foreclosure, or you're going to be forced into a short sale situation. And that's exactly how you can easily get hurt financially owning real estate if you don't be careful and pay attention to what's happening to the market out there and get the best deal you possibly can. Remember this, guys, if you don't remember anything else from this video, you can never change the purchase price. That's permanent. But you can always change the interest rate, okay? Just remember that. It's basically as simple as that. And what Josh is saying is the opposite. Now, another one of my loyal viewers, Nick, he sent me this story saying that 60% of the price surges that we saw across all markets were due to remote workers. And once again, guys, I'm not here to villainize remote workers. I'm just reporting what's going on out there. And there was a study done that basically found that when an area received a remote worker, that the results are basically neck and neck. If an area gets a 1% increase in remote workers, then home prices go up about 1%, okay? And so you can look at all these markets that saw this massive appreciation over the past couple of years, and they're saying that more than half of this is attributed to remote work. People that are coming from very expensive areas, guys. We're talking about Los Angeles, we're talking about San Francisco, we're talking about New York City, we're talking about Chicago, places that are very expensive to live in, that offer very high salaries, and if their job goes remote, like many of them did, they're now allowed to live anywhere they want. And for someone making $200K a year at a remote job, you know, moving to Tampa, Florida, let's say last year, and the median home price then was like $300,000. That's nothing, guys. I mean, you're just using a very small fraction of your salary to buy a really nice home in a nice area back then. So that's what people were doing. And when you have this type of thing going on, pretty much what it is it's reshaping our economy. It's reshaping the entire landscape of the housing market, of, you know, where home values are going to continue to go up, where they might go down. And that's why I keep talking about this trend about the potential reversal of remote work. And I think we're going to see a little bit of a push-pull situation going into next year. You know, we see on the one hand some companies completely requiring people to come back at least a few days a week, but there was a situation with GM recently where they required their workers to come back to the office a few days a week. People basically revolted and said, no, we're not going to do it. And GM pretty much gave in. So this could be a helpful tip to a lot of you remote workers out there. You know, band together with your coworkers. If the majority of you are happy with the remote work situation, then get together and say, no, none of us are coming back if you guys are going to do this to us, because we're happy like this now, and we're going to stay remote, and whether you guys like it or not, because they need people to work, guys. If there's nobody to work, the company ceases to exist. It's that simple. So if there's enough people saying no, they basically need you more than you need them. Another thing I want to talk about is pensions right now. A lot of people who are coming up on retirements in the next few years might still have a pension coming to them because you've been in the workforce long enough to where your job might be offering you a pension, okay? And we're going to look at this example from the UK right now. And what's going on over there is pretty much the same thing that's happening here in the States, but it's all coming to a head faster over there. So the reason why we need to look at this, guys, is because all the problems that the UK is having with the housing market and their pension funds right now are all problems that can come to us right here in the United States sooner than later. So that's why we're looking at this. And also, I know a lot of you guys watch my channel from the UK, and I want to cover what's happening across the pond as well. So the UK holds about $1.7 trillion in assets in the form of derivatives, which are basically risky investments in the stock market over there, where these pension funds will invest in these highly risky, highly volatile funds in hopes to generate higher returns for their pension funds. And right now, the stock markets are crashing everywhere, including over there. And now that interest rates have shot up, some of those trades that these pension funds have made are literally collapsing in value overnight. And they're pretty much in a Lehman Brothers situation right now, similar to what we saw in the 2008 financial crash here in the United States. So without going into too much detail on that, the reason why this is a big problem, guys, is because a lot of the pension funds here in the United States are taking the same risks and gambling your money in the same fashion right now. Because what they do is the regular investments that these pensions were investing in were not making the returns that were promised to pay pensioners the salary that they need to pay people, right? And what they do is they take chances and they'll invest in even riskier investments in the market in hopes to generate better returns. But now that we're seeing this global financial crisis, we're seeing all of these funds collapse in value basically overnight. Guess what happens to the value of your pension? It gets collapsed in value overnight along with it. And a lot of people say, no, there's no way they cannot pay my pension. I have it in writing. I have a contract that says they have to pay me X amount of dollars in retirement. And if they don't, then there are insurances in place that will pay it on their behalf if they can't afford to. Well, guess what, guys? Look at what's going on with insurance. Just look at Florida as one example. Insurance everywhere is in trouble right now, and the pension insurance funds are no exception. These guys are going broke as well, and all it's going to take is a couple different pension funds to go bust, and so will the insurance companies, and you might not see the pension at all. So that's why this is really scary right now, because a lot of people that worked an entire lifetime for that pension may end up not getting it, or getting only a small fraction of what they were promised in retirement. So this could be really bad for anybody who is expecting to get a pension right now. And to give you a real world example of how this could play out, I remember a few years ago hearing about a situation from a man who was supposed to retire from UPS. He worked there for 30 something years, and his pension was supposed to be $5,000 a month for the rest of his life, okay? Not a bad salary, considering maybe he has a 401k also, maybe you're going to get Social Security later down the road, so that income will even go up over the years. So $5,000 a month from the pension, not bad at all. But what ended up happening when this guy got to his retirement age from UPS, the pension fund was in big trouble, just like many of these other pension funds are right now, and the final number that they could guarantee him was $2,000 a month. And that's it, guys. There's no recourse for this. There's nothing you can do to basically get that money, okay? So you were promised $5,000, now you're looking at only getting $2,000, less than half of what you were promised. And so what ended up happening is the guy couldn't retire. So you need to be looking at this right now. And if you are supposed to be getting a pension, and let's say you're not ready to retire yet, one thing you should be doing is requesting that your pension fund gets a full audit done. And basically what this does is you're gonna have professionals go through the numbers and see, is this pension going to be able to pay the funds that they're promising? And if not, what can be done about it before it's too late? So the problem is, it's probably too late for many of them, and people just don't think about this until it's time to retire, and unfortunately by then it's usually too late. And speaking of the UK, another interesting thing I learned about your housing market over there today is that in the UK they don't really do foreclosures. So for example, if you end up in a bad situation where your house is worth less than what you paid for it and you need to sell it, doesn't matter. You can't just hand in the keys and go into foreclosure like you can here in the United States. It's not that simple. Basically over there, even after you sell it, you're still going to be on the hook for the debt. Even if you can't afford to pay it, whatever, guys. And this can completely ruin your life to the point where, you know, your whole life can be altered by this amount of debt. So buying over there is even more risky than it is here. And these type of situations, like listening to guys like Josh Flagg, is a way to get yourself completely turned upside down and ruin the rest of your life, especially if you live in the UK. So you better think twice if you live over there before buying something right now. This ended up being the only listing I saw on this whole walk. And they tried selling this place for 6 months, had it originally listed at $5,390,000, lowered it to 4.9. Nobody bought it. It's off the market. If you guys enjoyed this video and you found it entertaining, please subscribe to the channel. Check out my next video on the screen right over here, and I'll catch you over in the next one.